Hi guys, keep watching KS tutorials. They are the best.
Guys, keep watching KS tutorials. They are the best.
Hello guys, welcome to another episode of KS tutorials. You keep calm and then you balance on. On this episode, we will be continuing from where we ended the other day. That is the purpose of accounting. That is where we ended, the purpose. Today we'll be talking about the users of accounting information, the users. Who are the users of accounting information? We'll also talk about what bookkeeping is, the definition of bookkeeping, the characteristics of the useful accounting information, the differences between accounting and cost accounting and financial accounting, and even management accounting. And then some career opportunities there for you who is listening to me. If you study accounting, the career opportunities there for you. Aside accountants, what are some other career opportunities for you? Continue listening to us and then you'll get to know the career opportunities for you if you continue to learn accounting. And if you listen to us and then you pay attention. Thank you. Okay, so we have users of accounting information. Users of accounting information. Who are the users of accounting information? If let's say we have a financial statement, who do we need to send it to? Who do we need to communicate? We talked about communicating in the previous class or previous section. Today we are going to talk about who need it. So if you have the financial information, who are we going to communicate the information to? That is what we are talking about now. Who are we going to communicate the information to? So we have the owners. First, you cannot leave them out. Someone started his company. Do you want to leave the person out? No, you cannot leave the person out. So the owners or the shareholders. So when we talk about shareholders, we mean the people who own the company, the owners of the company, those who have shares in the company. We have companies that trade their shares. We have companies that do not trade their shares. So a company that trade their shares will be open for external investors to purchase their shares. And companies that do not trade their shares, it is the owners or the investors who started the company that owns the company. They are the bosses of the company. So the shareholders, they need the financial information or financial statements to make a decision. They needed to make a decision. Then we have management. Management are those employed by the owners of the company to oversee the operations of the company. So we can have the executive of the chief executive officer, we have the chief financial officer, we have the procurement boss, we have the marketing manager. All the managers, they come together to form the management team. So the management team also need this financial information to make informed decisions about the company. They need the financials of the company to make informed decisions about the company. So management also need the financial data. Also, we have customers. Who are customers? Customers are those who patronize the products of the company. These are the customers. They purchase the products of the company. So a company like, let's say, Vena Water. Let's say a company like Vena Water. Their customers are those who buy from them, whether in large quantity or in smaller quantity. Me here drinking from Vena Water, I am a customer. If you buy Vena Water, you are also a customer. So a customer is anyone that patronizes the product of a company. A customer is anyone that patronizes the product of a company. That's a customer. And then the next one that we're going to talk about is the creditors or the suppliers. Suppliers. So let's say you are into manufacturing. You're a company in the manufacturing field. any supplier that gives you raw material is interested in your in the progress of the companies. Yes, the progress of the company. So they want to know whether the people we are supplying our products to will be there in the foreseeable future to continue patronizing our products. These customers are worried. Even if they want to sell on credit to you, they need to know whether you'll be able to repay them in future. Let's say you want to buy goods worth 2 million Ghana cedis or 2 million USD, and then they want to sell it because you do not have the funds now. They want to sell it to you on credit. They need to understand that will this company be able to pay off if we sell to them on credit? Will they be able to pay off if we sell to them on credit? That is who that's why the suppliers also need the financials of the company to make decisions whether as to sell or not to sell to you as a company. Also, we have the employees. Employees, the staff of the company, they also need the financial information to know whether the company is going to continue with them or the company is going to lay them off. Whether the company is going to continue operation in the foreseeable future or the company is going to shut down. The employees also want this information to make decisions for themselves. But it's the company that will give them money to cater for their families. So they also need the financials of the company to make informed decisions about their lives. Whether the company is going to, job security is very necessary. Whether the company is going to exist for the future so that they will know whether they are still staying with the company or they are going elsewhere. So employees also need the information. Okay, so we have banks. Banks. Someone may ask, why banks? What do banks also need? So, a way of financing a company, is either through capital or let's say shares or loans. Where would you get these loans? From the banks. So before a bank will also give a company loan, they need the financials of the company to decide whether to give the loan to them or not. The banks also need this information to make a decision as to whether to give the loan to the company or not to give the loan to this company, and then to decide the number of years they are going to recoup their money back, why they are supposed to. So the financials is very necessary to banks. They need to know the liquidity state of the company, whether the company will be operating in the next year, 1 year, the next 5 years, the next 10 years, or the company is not in a good state, so the company is going to shut down. If a company is going to shut down, I don't think any bank would want to give their money to that company. That is why the banks also need the financial information to make decisions. It is money they are going to give to the company, so they need to make decisions. Also, we have public authorities. Let me say government. Government also need the financial information. Government need financial information of listed companies. Listed companies, as I said, listed companies are companies that trade their shares on the stock exchange, whether it is Ghana Stock Exchange or whatever stock exchange. Listed companies trade their stock on on stock exchange. They trade their shares. So companies that trade their shares, government need their financials. You need to publish it on the stock exchange platform, so that investors will also have it. Also, they need the financials to know the profit you are making to tax you. Government also need the financials so that they can be able to know the amount of tax you are supposed to pay. Please, are you okay? So government also need the financial information. So these are the users. So we have the shareholders, management, customers, suppliers, employees, and banks. Banks and government or regulatory bodies. public authorities. They need this information. So the next thing we're going to move on to is the characteristics of a useful accounting information. If an accounting information is useful, what are the few features that will show that this accounting information is useful? If you want to know that this accounting information is useful, it will be useful to the users. What will show? So the first one is relevant. A useful accounting information is supposed to be relevant to the user of the user of the information. Where the information is not relevant to me, let's say I'm an investor. If the information is not relevant, it's not making sense to me, then it means the accounting information is not relevant, it's not useful. It will be useful if it is relevant to me. That's the relevance of the information. It's supposed to be relevant. Understandable. A useful information, a useful accounting information is supposed to be simple to understand. It's supposed to be simple to understand. So whereby we've given a financial statement and then you do not understand, it will not be useful to you. That is why we go as further to use the ratios, to give you a better information on it, a simplified information so that you would understand, and also so that you will understand. So understandability is very necessary when it comes to accounting information. If you do not understand, then we are not meeting our target as accountants. If you do not understand the information, then it means the information is of no use. So understandability is very necessary to the usefulness of accounting. So the one characteristic is understandability. The next one is reliability. Let me say reliable. A useful accounting information must be reliable. We should be able to depend on the information that the accountant has provided. The company is supposed to be able to depend on it to make informed decisions. If the company cannot depend on the information given, then the information is not reliable, then the information is not useful. A useful thing is something that I'm able to depend on. So if we cannot depend on the information provided to make informed decisions, then the information is not reliable. The information is not useful to the company. So it must be reliable. We should be able to depend on it. The next one is unbiased. Unbiased information. The information, that is what we call faithful representation. The information must be true and fair. There shouldn't be any fraudulence in it. It should represent the company. Like it should be realistic. It should represent the company. There shouldn't be any I don't know how to put it, but the information shouldn't be biased. The information shouldn't be biased. It shouldn't benefit one party and then it should benefit. No. It should be fair. It should be faithfully represented. That is the unbiased information. It should be faithfully represented. It should be fair to the company. It should represent the state of the company. Let's say if the profit is negative, if you are making a loss of 10,000, we are supposed to state it, a loss of 10,000. We are not supposed to massage the figure to make it look like we made a profit once we are making a loss. It should represent the state of the company. The next one we are going to talk about is it should be complete. The information must be complete. A half information we cannot depend on a half information and then make a decision with it. No, it is not possible. So we need a complete information to make a decision. We need a complete information to make it. So the information will become useful if it is complete. If it is complete, then it is useful. Complete and useful. The next one we are going to talk about is timeliness. The information must be provided on time. The accounting, financial information must be provided on time. Let's say I need the information to make a decision today, and then the information comes tomorrow. It didn't come on time. I might not be able to make the decision. So the information must be produced on time. The information must be produced on time. Then comparability. Comparability. I'm saying comparable. The information, we should be able to compare the information. Let's say this year's information should be compared, we should be able to compare it to next year's information if we are using the same accounting policy. If we maintained a consistent accounting policy, then we should be able to compare the information. We should be able to compare our financials to a different company in similar industry. Let's say we are all in the bookmaking industry. My financials should be able to compare to you so that we can make decisions. An investor should be able to compare to make decisions. Okay, this industry is making a profit of 10,000. This industry is making a profit of 5,000. But this industry has more assets than this industry. This industry's debt is higher than this industry. If they're able to compare the information, they can make informed decisions. So that's the comparability of accounting information, which makes it useful. It makes it useful. The last one is variability. Variability. We must be able to verify. We must be able to cross-check and then see if there are errors in the financials. We must be able to, we should ensure that the accounting information that we are putting out there is correct, free and fair, no bias. So we must be able to verify it. That's verifiability.